as an individual, you can essentially function as a bank.
Yes.
So you can go out and buy mortgages, land contracts, on the market and hold them. And then you kind of have all the same rights as the bank does, which is pretty powerful.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larsen. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's show, we have a fun episode with Dan Deppen. He is the owner of Call the Underwriter, where he helps real estate investors create compliant, high-value seller finance notes. After a decade in aerospace engineering and 12 years in tech companies like Oracle and AWS, Dan began investing in notes in 2017 and has scaled his portfolio using outside funding. He now specializes in mortgage underwriting and Dodd-Frank compliance with a mission to make seller financing safer and more profitable. And a lot of you have heard me talk about the 18-and-a-half-year real estate cycle. You can check out episode 100 if you want to go and do a deep dive into that. But right now in the real estate cycle, as rates have risen, real estate prices have risen, it's a great time to become the bank. And Dan's going to share how you can do that in your investing journey as well. Dan, welcome to the show.
Chris, thanks for having me.
Absolutely. Yeah, we were just talking, man. I'm a little envious. I love Colorado. You're out there in a beautiful area of the country just outside of Denver. Yeah, we fortunately we live up here in the hills and the mountains of Asheville, North Carolina. It's a little different than the Rocky Mountains.
It's not too bad either, though. Yeah.
Oh, no, it's great. I love this time of year. We're wrapping up summer here in Asheville, and it was in the 60s this morning. It was just beautiful. No, I'm excited for you to share a little bit more with the audience about what you're doing here. We're going to tap into an area that was one of the early areas that I started investing was in note investing. So we're going to talk a little bit about what you do there as well as how to originate notes, Stan. But before we do, I'd love for you to share with the audience some more about your background and your business and Call the Underwriter.
Yeah, so I'm on my third career now at this point. So I started as a mechanical engineer in the aerospace industry, and so I did that for about 10 years, which I really enjoyed. Did some cool stuff. Kind of got to where I liked it, but I didn't want to do government contracting for like another 30 years or so. So
Yeah.
after about 10 years doing that, I left. I went to University of Colorado, did my MBA, kind of took 2 years off. Then went into product management in the high tech world. So like worked at Oracle for 6 years, worked for
Oh, wow.
AWS
Yeah.
most recently, and did some startup stuff. And then along the way in that, I started getting involved in real estate investing and kind of started to scale that out and build it out. And now focus on buying notes full time, and then also, yeah, we can get into it. A company called the Underwriter, so doing
Yeah.
RMLO work and underwriting and originating of seller finance loans now.
Yeah, terrific. Yeah, let's take each of those separately here, Dan. So, about 15 years ago, I got into the note space. So I started buying notes with a partner. We were buying distressed debt
Oh,
at the
that
time.
was a great time to do it. I wish
It
I was
was,
in that. I started
yeah,
like 8 years ago, but I wish I
yeah.
would have started then. Yeah.
Oh, yeah. You could get notes like 10, 20 cents on the dollar.
Yeah.
So for the audience that's not familiar with that space, maybe you could share a little bit about, kind of what the note space is, talk about performing, non-performing notes, what the differences are.
Yeah. So some people don't even realize you can do this, but
Yeah.
as an individual, you can essentially function as a bank.
Yes.
So you can go out and buy mortgages, land contracts, on the market and hold them. And then you kind of have all the same rights as the bank does, which is pretty powerful. So
Yeah.
there's a million flavors of notes. Like at a high level, we kind of tend to put them in two buckets, right? So there's like
Yeah.
performing and non-performing. Performing is what most people would, think of. That's where
Right.
borrowers making payments every month, and you just sit and collect cash flow, right? So it's just
Yeah.
kind of like any other kind of cash flow investment. And then you can get into the non-performing world, which I've done a lot of those. It's not
Okay.
always for the faint of heart, but that's
Yeah.
when you go out and buy a loan where actually the borrower isn't making payments or they're behind. And then you either like do a workout with the borrower or, you can take it through the foreclosure process. Those are real
Yeah.
wild. So what's interesting within the world, even though the world of notes is fairly small, when you dive into it, you can have like radically different business models. So if you're focusing on the performing notes, which I kind of recommend, especially if you're starting out, it can
Yeah.
be, depending on what you buy, it can be like super stable, steady cash flow income. And then as you get into different parts of non-performing, it can really be the Wild West with a
Yeah.
wide range of outcomes.
Yeah. So why, I guess, for the audience that are listening, like why would you want to buy a non-performing note? Like people aren't making their payments,
Yeah, so
why
the
does that even make
you
sense?
yeah, so the reason you would buy them, right? Yeah, and intuitively it's like why would I buy a cash flow thing that's not cash flowing? Well, number one, loans in general, even when they're performing, tend to sell at a discount, right? And the actual amount of discount you can get varies widely. But say you buy a loan, it's not performing, but you've bought it at 50 cents on the dollar. And maybe there's equity in the property, so the property's worth like even more than what the loan balance is. Now you've got a lot of room to maneuver, right? So if the borrower just never pays, you can take it through the foreclosure process, which,
Mhm.
costs money, takes time, you're waiting, but then you could eventually get made whole and get the whole 100%. Or if you can work something out, if the borrower is still owner occupied, the borrower is still interested in staying, depending on why they defaulted or if you can make contact with them, sometimes you can work out forbearance agreements with trial payment plans and
Yep.
loan mods to get them paying again. So if you can get that loan paying again, you've got a cash flowing loan. If you season it, so that loan you bought for 50 cents on the dollar, maybe you're holding it for some period of time and collecting payments, maybe as part of your agreement with the borrower to get performing again. They made a good faith down payment that you collected, and now your performing loan is worth 90 cents on the dollar, and you can turn around and resell it and do really
Yeah.
great. So that's like
Yeah.
the upside of them. But you do get some where it's non-performing, you have to foreclose, you get it back, and the property is just not what you were expected. Because
Right.
one of the
Yeah.
big risks, especially when you do non-performing, right,
Yeah.
is when you're buying a loan, it's very different than buying a property, right? So if you buy a property, you're gonna look at it inside and out, probably
Mhm.
get it inspected, do all this stuff. But if you're buying a loan, you can't do that, right? You can go get photos outside, but you can't even see the inside. You can't contact the borrower. Like a lot of people listening, right? Like you've probably had like the mortgage in your primary residence be bought and sold in the past. Like I know
Yep.
mine
We've had it.
has
Absolutely.
a
Yeah.
number of times, right? And
Yeah.
and and when that happens, no one like comes in and inspects your
Right.
house. So yeah, so you can sometimes be in for surprises after going through this long process.
So Dan, you mentioned some of the pitfalls of note investing. So let's talk about kind of like a worst case scenario. So you buy a non-performing note at 50 cents on the dollar, and the payments don't resume for some reason. Like what happens then at that point?
Yeah, so at that point, you can't work out anything with the borrower. Like I've had ones where I was never able to make contact with the borrower.
Yeah.
They just like went to ground. So well, one option you have is you can cut your losses and sell the note
Yeah.
to somebody else, right? And so you'll lose like
Yeah.
a
So
little
if,
bit.
yes, if you bought a pool of notes at a discount, a lot of times with notes you can buy like a pool of notes, right? Like a tape. You
Hmm.
could buy 5, 10, 100 notes, which is what we were doing. We were buying as a group, these notes, and there was other
Yeah.
stuff thrown in there, like other debt thrown in there. So yeah, you could recoup a portion of your capital, especially if you're doubling your money on another portion of the portfolio, right?
Yeah, exactly. But what I generally do, or at least like let's take the case where I'm buying like a one-off note.
Yeah.
I and this is my model personally. Different people do it different ways,
Yeah.
but I don't like to buy a note unless I'm willing to go all the way through the foreclosure and take the property. Because for me, that like enforces a little bit of discipline
Yeah.
on the front end. But basically, so if you've failed in the loss mitigation, at that point, I'll start the legal process. Now, how long that takes, what it costs, kind of varies state by state. If it's a non-judicial state, it might be a couple $1,000s and maybe 6+ months. If it's a judicial state, it might be 5, $6,000, maybe more, and could be like over a year. And that's assuming the borrower doesn't fight you or you don't have any weird hiccups.
Yeah.
But then basically, once you go through the foreclosure process, you'll eventually get the property back. Now, if it was owner occupied and the borrower didn't leave, you might have to do an eviction if you ended up with the property. Sometimes, if it's gone to a sheriff's auction, someone else might buy it, so you might just get paid at that point. There's like a lot of ways those can go. But to get your question about the worst case scenario, and I'll
Yep.
describe my worst deal that I had. This
All
was
right.
in Muncie, Indiana. So I was like never
Okay.
even able to make contact with the borrower. Took it through foreclosure, got the property back, and the outside, didn't look awesome. It didn't look too bad. And this was one of my
Sure.
earlier non-performing deals too. But once we got inside, we found out like it was a full-blown hoarder house, like literally waist
Oh,
deep
yeah.
trash throughout the
Oof.
entire thing. And I think if I remember right, this was about like an 1,800-ish square foot home, and I had to order four 40-yard dumpsters to
Wow.
get all of the stuff out. So there was an expensive clean out. The house was really messed up. So like at that point, I couldn't sell it to to like a retail buyer without.
Yeah.
So I wanted to take on a rehab project, which for me,
Right.
I buy notes. I don't have
Yeah.
rehab teams on the ground, right? So if you try to do big rehab as a one-off from out of state,
Yeah.
you're asking for you're asking for trouble. So basically, when I got it back, that property was worth a lot less than
Sure.
than what I had expected. So I ended up taking a pretty decent loss on that one ultimately.
Yeah. Yeah, and that's, I mean, I think that's part of it is understanding what that is. And we have a debt fund where we're financing fix and flips, and we know that sometimes we've had a handful of those loans default, and we know we have to take those homes back, and we either sell them to another investor that's going to rehab it and we recoup our capital, or we have to take it over ourselves and do it. So I think either understanding the pathways that you have there, or having a partner or a group of people that you can work with if you have to get rid of a property like that, if you're buying the note, can make a lot of sense.
Yeah, and I think to keep in mind, like, well, just about anything, but especially with like if you're doing non-performing notes, it's really a
Yeah.
numbers game, right? It's like I've got
Yeah.
a model I've used a lot, works pretty well, and so most of the time,
You are an
you
engineer,
know,
so
I am, yeah, I'll have
yeah.
like a pretty solid return, kind of base hits. But if you
Yeah.
do enough, you will get a couple that go super sideways, like the one I described. But then you also get a
Yeah.
couple like super home runs. Like I've had ones
Right.
with just like fantastic, returns where like you
Yeah.
double your money and the whole thing was just super easy and all of
Yeah.
that. So if you do enough of them, it works out if you have the right model. But any given one could be a horror show. So you just have to like keep that in mind.
Yeah. No, I think that's great. Well, we kind of started with the worst case scenario here. Let's talk about the performing notes. So
Yeah.
let's talk about like what a performing note looks like, specifically on real estate, because there's all kinds of different, you can buy pools of debt, credit card debt, and all kinds of different things, as well. But let's talk about like, your bread and butter performing residential note. Like, what does that look like?
So those are what I like to buy for my self-directed IRA.
Yes. Yeah.
And so basically what those look like, they could come from a variety of places, right? So sometimes I'll buy them from individuals in my network that do things similar to what I do, and maybe they have an investor that wants to cash out. There's like small note funds you can
Hmm.
buy from. There are some online exchanges like Paper Stack. The one thing that really won't work that is everyone's first instinct, and it makes sense why it would be, but you're not going to walk down to your local bank and ask them what loans they have for sale, right? So it's like big
Yeah.
bank loans. They kind of, the bank's either holding them or they're going to larger hedge funds. They're not necessarily going to sell you like a one-off individual one. Or if you do, the pricing is probably not going to work for you because their cost of capital is so low. But and the
Yeah.
other thing I'm often buying are a lot of seller finance loans
Seller
that
finance loans.
people
Okay.
create
Yeah.
that can be on a variety of different things.
Yeah.
Uh, so what that kind of looks like is usually it's for me, I buy a lot of notes on properties that are maybe either like sub $100,000 properties in the Midwest, or maybe up to a couple $100,000 properties. And a lot of these seller finance loans, they're written at 9-10% interest rates. You're often buying them at a little bit of a discount. So you can buy pretty stable
Yeah.
loans where borrowers are making payments, regularly that are yielding, north of 10%. And,
Yeah.
and so that's nice because then basically, you go through that process, you buy the note. What you'll do is you'll use a loan servicer.
Hmm.
So there's a host of regulations obviously involved in mortgage. And so as a loan servicer, like you're never going to comply with that stuff on your own. There are people who do it, but
Yeah.
good luck. But what you do is you just use a loan servicer. It's boarded there. The loan servicer is going to send the payments to your borrower. They're going to collect payments from them. They're going to track, the amortization schedule and the balances and the payoff amount and all that stuff for you. So you buy a good one with a good borrower, you should be able to just sit back and collect cash flow. Now,
Yeah.
if the loan does default, you may have to go through the foreclosure process. And, even good loans can default. Like I had one where the borrower passed away. He was paying reliably,
Yeah.
the
Yeah. We've
borrower
had
passed
that. Yep.
away, and then you didn't really have it. I mean, we got it worked out, it's fine. But, even on a very stable loan, like, stuff does happen. So you kind of have to be prepared. But if you're buying them too, where there's a lot of equity, right? So buy loans, like I like buying loans that were originated, 5, 10, 15 years ago. Prices on those homes have gone up a lot and they've paid the
Oh
bank
yeah.
down. So I have a lot of loans where there might be like an 80K loan balance, but the property's worth north of 200. So it's kind of like
Really nice. Yeah.
you're either going to pay every month and I get paid, or I've got tons of room for fallback plans if they don't. So they can be really nice,
Yeah.
stable investments.
I like that. So you mentioned you're buying some of these notes at 9 and 10% interest rates
Hmm.
from people that have originated these loans. Give us an example of that. And I know you help investors do that as well and teach people how
Yeah,
to do
so
these
so there's a
things. So
whole industry of
yeah.
folks who originate notes, and there's like a lot of different business models that people use. But
Yeah.
and so the reason that this exists on, say like single family residential, right, is so everybody remembers the financial crisis where banks were doing, crazy stuff and not even underwriting at all. And
Right.
then they put in all these regulations, like namely like Dodd-Frank, that says, hey, if you're going to make a loan to somebody on their primary residence, you have to validate that the borrower has the ability to make payments. So
Yep.
they kind of set this like minimum bar for lending standards. But in the years since, for a variety of reasons, banks have on their own turned their standards way, way up, right? So there are a lot of borrowers who you can create a compliant loan for, but they're not going to meet the bank standards. That could be because they're an ITIN borrower. Banks often tend to frown on self-employed folks,
Mm. Yeah.
different things. So there are a lot of really good borrower credit that have good incomes that for various reasons aren't going to be able to get financed through a bank. And so a lot
Yeah.
of times that's where seller finance comes in. So your typical seller finance deal, the terms are all over the map, but I would say kind of like the average is the borrower's making about a 10% down payment. You've got about a 9 or 10% interest rate, and then it's set up over 30 years. And then,
Yeah.
there's a million flavors,
Yeah.
in between.
Yeah. And you also help investors do this as well, right? If they want to do that. So
Yeah, I
um,
do. So
yeah.
with called the Underwriter, where it's called an RMLO, or residential
Yep.
mortgage loan originator. So what we do is help investors with all the compliance. Well, there's two phases to it. Some of it is dealing with compliance and regulations, right? So you have to
Okay.
comply with Dodd-Frank. There's this other thing called TRID, where you have to send out, loan estimates and closing disclosures, and kind of similar to the loan servicing. Once you have a system set up to do it, it's not that hard. But if you were trying to do it as yourself as a one-off, like
No fun.
there'd be a lot of brain damage involved with
Yeah.
that. So part of it's the compliance, which is real important.
Yeah.
And then the other part is just the underwriting, right? Like if you're selling a property and you're holding a loan,
Yeah.
you want to know what kind of borrower you have, and you want to know that this thing is going to cash flow steadily
Right.
over time. Now, a lot of times people create these and their intent is just to hold the loan. That's
Yeah.
fine. But the other thing too is a lot of people who get into creative finance and seller finance, they're typically into all kinds of stuff, and they do other kinds of real estate. So one of the nice things too about holding a loan, if you got a quality one, can be really liquid. right? You have the option, like you
Hmm.
could sell if you have a good loan, you could sell it if you want to free up the cash for something else. And then, not to rabbit hole on it, but you can also
Yeah.
sell like what are called partials. Like
Yeah.
let's say I hold this loan for 30 years. I want some cash for something, and I might sell you 3 years worth of payments, but then
Right.
I'm keeping
Yeah.
the back end. So
Yeah.
you can do all kinds of cool stuff with them.
Yeah. Yeah, one of
Once
my
you,
favorite strategies was you could buy a loan, you could work it out, like a non-performing loan, work it out, sell a portion of the payments on the front end so that you
Mhm.
recoup your capital, and then stick the tail in like your self-directed IRA or something like that.
Yeah. Yeah,
And
especially when you're
yeah,
buying at those low prices years
yeah,
ago, right? You could probably refinance yourself out.
yeah,
The other thing that people will do, so as far as like where people get properties to sell or finance, there's like a million models. Some of them,
yeah,
a lot of the folks that do this are like home investors, franchisees, and,
yeah.
cash buyers. So
Ah,
it's almost like a
yeah,
variation on a fix and flip strategy, and they
yeah,
may not even fix depending on what the condition of the home is. But
right,
one thing people do if they can get a property, for a lower price, let's say they make a cash offer, they then turn around, sell the property on owner finance, but instead of creating one loan, they'll create two. So they
mm,
might collect the 10% down payment
hmm,
and create an 80% first position mortgage and a 10% second position mortgage. And they'll do a similar thing, I think, to what you might have been doing, where if you buy right and you structure it right,
yeah,
they'll sell the first, and now they basically finance themselves out, and they'll sell this 10% down payment, and then they have this 10% second they're holding free and clear.
yeah,
And then they can just kind of pile those up
yeah,
over
yeah.
time.
That's beautiful, and it's a way you can stack these strategies and
Mhm.
do that. I mean, who's your ideal client, Dan? Let's talk about that. Like, who do you work with? Who do you really help out with your business? Call the underwriter.
Yeah, so there's a bunch of different profiles. Like so one of them are like the cash buyers, home investors, franchisees that are doing a
Yeah,
lot. There's a lot of people doing subject to deals and wraps because as part
yeah,
of that, you're creating another note.
yeah. So let's pause on that. So yeah, talk about
Yeah.
like what a subject. I know what that is, like a subject to deal or a wrap, or how that works, and why. Like right now, a lot of listeners have heard me talk about the real estate cycle and why now is a great time to be the bank, and we're seeing some of these strategies that worked 10 and 20 years ago come back in right now.
Yeah, so right now, right, there's a lot of existing mortgages that are written at, 3, 4, 2.5%. So
Yeah.
what people will do is they'll go and find a property for sale. Maybe it's one where the seller was trying to be too aggressive, the listing expired or the listing stale, or maybe they just don't have a lot of equity and they need like a certain price because they can't get out of it without putting in cash. Well, then, what you can do is roll in and say, hey, no problem. I'll buy your property for what you want, but I'm going to assume your 2.5% mortgage. So you buy
Yep.
this property and now you've
Yeah.
got, like super low financing that you've assumed. And then what some people do is, you can turn around and take it a step further, sell the property on owner finance and now create maybe like a 7 or 8% loan. And now you're creating big spread, and you can also structure
Yeah.
it to where like you actually get cash out of the deal up front, and then you're creating
Right.
this big monthly spread. And then,
Yeah.
your new loan is hopefully bigger than the loan. Now, that's like highly technical and the devil's in the details
Oh
on how
yeah.
to do it. I haven't actually done one of those myself, but I'm going to start doing that
Yeah.
next year. So I've been going down those rabbit holes, like, because it's one of those things that can be a good strategy. There's a lot of confusion over it. If you do it right, it can be fantastic. If you do it wrong, you can create some
Then go.
nightmares.
Yeah.
So
Yeah. Then go
yeah,
sideways
you
quickly.
got to
Yeah.
tread lightly
Yeah.
if you go there. But those are and that's increasingly popular mainly because interest rates have gone up, but then there are all these low interest rate loans. In fact, in
Yeah.
the 80s, there was a ton of this that went on. It's
Yep.
actually not a new thing. Some people think it's new,
Oh
but
no.
this has been around
Oh no,
for
no, no. This is one of the first strategies
forever.
I learned about in the late '90s. Yeah, and
Yeah, yeah.
George Allen, and I'm trying to remember who else was doing the. Was it who was the guy that was the big subject to guy?
Well, I mean, Pace Morby's the one now. I
Pace
don't think
Morby is
there's
the
anyone
guy
in the
now, but no,
past.
this is no. There was a guy way back in the early '90s, like on infomercials and stuff like that. So,
Oh,
um,
I know who
yeah,
you mean. Yeah,
yeah,
I can't think of it, but I know the person that.
Yeah, I gotta look. He's all flashy, and he looks. Was it Ron or something like that? Yeah.
Yeah, yeah. But then, so that's another one. And then the other one that the other kind of model that's increasingly popular is people with rental portfolios
Yeah.
who no longer want to deal with, property management. Maybe they're retired or getting near retirement, or, their costs have gone up over time. Like one of the things people are doing a lot is they'll take a rental property, sell it. And historically, people might be hesitant to sell because if you've owned this for a long time, if you own it free and clear, right, you're going to
Yeah.
get nailed with taxes. But
Yeah.
what people are doing is they'll sell the property, they'll do owner finance, create a loan. So now they've still got cash flow. They're not on the hook for property management. They're not on the hook for fixes and capital repairs. And then I'm not a tax guy, but because they
Yeah.
sold it as a loan, they collected a down payment. They're spreading the money they receive from that over time. So it's more of a installment sale. So they're not getting hit with all the taxes like up front
Yeah.
when they do it. So that one's been increasingly popular.
Yeah, no, I love it. And if you're listening, you have a property that you have, you're an investor and you want to do this, you can reach out to Dan. Check him out at calltheunderwriter.com. And it was Carlton Sheets that I was thinking of.
Okay. Yep.
Way back. Yeah, that was way back in the day. I had a box of all this different stuff. He was one of the the things I had in there. So yeah, it's really cool as you look at these strategies. And I think if you understand where we are in the real estate cycle, you can layer these in. So Dan, thanks for sharing a lot about this strategy here today. How people can not only use notes to invest in, but also use notes to help supplement their strategy. And I mentioned your website, calltheunderwriter.com. What's the best way for people to get in touch with you if they want to learn more?
Yeah, there's a form there. They can send me a note there, or you can always email me directly at dan@calltheunderwriter.com as well.
Awesome. Well, Dan, thank you so much for your time today. I appreciate you sharing your wisdom with our audience.
All right. Thanks for having me on. I enjoyed it.
Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.